Why stocks could drop 10% over the next 8 weeks, among China's weakness that might affect US stocks. Investors are awaiting what could further inform the Fed's rate decision on September 18th. Traders see it as a certainty the Fed will cut by at least a quarter point. Monday's rally comes after the stock market suffered serious losses to kick off its first trading week of September, which is historically a tough month for equities. These declines came as the August jobs report stoked fears of a slowing labor market. The S&P 500 averaged a 0.7% decline in September, the worst track record of any month, according to the Stock Traders Almanac. Tom Lee suggested that the market could fall between 7% to 10%, and recommended that investors should be cautious for the next 8 weeks, and gear up for elevated turbulence. Since the stock market has been up for 7 of the 8 months this year, he thinks that after September cuts, people will get nervous. That's partly a reference to the Federal Reserve's upcoming policy meeting in mid-September, during which the central bank is expected to slash interest rates by at least 25 basis points. Stocks are facing a possible double-digit drawback in the next 8 weeks as a slew of market-moving events temporarily challenge this year's gains, Fundstrat's Tom Lee told CNBC. China is showing structural weakness, and some analysts think it could influence the US stock market at any moment. The weakness in China could be structural, according to Barclays. The firm said it has become incrementally more cautious on the luxury goods sector as a result of a worse-than-expected Chinese macro backdrop, and downgraded Burberry and Kering to underweight. Reality check: it's worse than we thought, analysts Carol Maggio and Wendy Liu wrote in a Monday note. There is now a clear view that the Chinese weakness is structural and not just cyclical. On luxury goods, this translates into negative summer sales in mainland China, up to 50% decline, and to clients being more and more selective. Sales in the third quarter are forecasted to fall to significantly negative ranges for most brands, the analysts added. Further downward revisions could be ahead for Kering, they added. Sentiment in China remains very poor and most of the feedback suggested that recovery will take time. Although VIP consumers remain relatively resilient, they are not immune to the slowdown and some of them have also been feeling pressure, the analyst said. So, how could China's economic weakness significantly impact the US stock market? That could happen in several ways, given the interconnected nature of the global economy and the influence of China's market on various industries. Here are the key channels through which China's weakness might affect US stocks. 1. Global supply chains disruption. China is a major hub for manufacturing and supply chains for many US companies, especially in technology, automotive, and consumer goods. A slowdown in China's economy can lead to supply chain disruptions, increased costs, and reduced profit margins for US companies reliant on Chinese manufacturing. 2. Lower demand for US exports. China's economic slowdown reduces demand for US goods and services, particularly in sectors like technology, agriculture, and luxury goods. This can hurt the revenues and earnings of US companies with significant exposure to the Chinese market, such as Apple, Tesla, and various consumer brands. 3. Impact on commodity prices. China is one of the world's largest consumers of commodities, including oil, metals, and agricultural products. A weaker Chinese economy often leads to declining commodity prices, which can hurt US energy, mining, and agricultural companies. Lower commodity prices can also signal broader global economic weakness, which can further weigh on investor sentiment. 4. Negative sentiment and market volatility. Concerns over China's economic health can lead to increased market volatility and risk aversion among investors. US stock markets may experience sell-offs as investors react to uncertainty and potential ripple effects on the global economy. 5. Impact on multinational corporations. Many large US multinational companies derive a substantial portion of their revenues from China. A slowdown in Chinese consumer spending can negatively impact earnings, leading to lower stock prices for companies heavily exposed to the Chinese market, such as Nike, Starbucks, and semiconductor companies. 6. Stronger US dollar. Economic weakness in China can lead to capital outflows from emerging markets into safer assets like the US dollar, causing the dollar to strengthen. A stronger dollar makes US exports more expensive and less competitive abroad, hurting US companies' international sales and profits. 7. Broader economic contagion. a sustained economic downturn in China can have broader global repercussions, affecting other emerging markets and economies that are significant trade partners with the US. This could contribute to a global economic slowdown, which would impact US companies and investor confidence. 8. Financial market linkages. Many US financial institutions have exposure to Chinese markets through investments, loans, and other financial instruments. A downturn in China can lead to losses in these investments and increase the perceived risk of doing business in or with China, affecting the financial sector. In summary, China's economic weakness can influence the US stock market through supply chain disruptions, reduced demand for exports, commodity price changes, negative investor sentiment, and broader global economic impacts, all of which can contribute to volatility and pressure on US stock prices. Could the Fed's interest rate cuts be bad news? Analysts have separately indicated that the market might not welcome deeper cuts. Bank of America wrote on Tuesday that if the Fed had to cut by 50 basis points instead, this would likely be in response to elevated recession risk. Lee has been largely on the mark with his stock market calls in 2024, heading into the year as one of Wall Street's bullish forecasters. His optimism has been met in the form of an 18% year-to-date gain for the S&P 500 through Friday. Meanwhile, election uncertainty may put off investors until the results are known, experts told Business Insider. Even outside an election year, September is a challenging month for stocks in a non-election year. But when voters head to the polls, seasonal volatility can extend as far as mid-October. There's a silver lining. Investors can expect a relief rally once a president is chosen. Lee similarly cited that the tough weeks ahead should be viewed as a buying opportunity. I think in the next 8 weeks, people get a chance to buy, he told CNBC. I think it's good to be cautious, but just ready to buy that dip. The strategist has been one of the market's staunchest bulls. In June, he argued that the S&P 500 could triple this decade, reaching 15,000 by 2030. Thanks for watching. Good luck and good profit. By Edward Cash Trader. Please read the disclaimer in the description below. You can support the channel by subscribing and turning on notifications. Let's grow the channel together.